The stock market had a great January. It's been a little bit more difficult in February. The primary reason for the difficulty in February is that the Federal Reserve Powell has basically made it clear that he expects the federal funds rate to get up to at least 5.25% and stay there dramatically longer than most financial market participants were expecting. This 5.25 for longer message has been reiterated throughout this tightening cycle. The market participants were hopeful up until recently that that was more talk than actually action, but it does look like Powell and the rest of the Federal Reserve is intent on doing this. The main reason I think that market participants are a little doubtful is most people have not been involved in the investment business except in a very low federal funds rate environment. And historically, Fed funds rate has run at or above the inflation rate. You can see here on this chart that back in the 70s and 80s, the Fed funds rate was above inflation. Currently, inflation is running around 6%. That would mean that the Fed funds rate to actually be running above inflation would need to be around 8, and that would be something that would be dampening of the economy and dampening of inflation. We do look like that we've had a nice little slowdown in inflation. Inflation has barely moved on the past 6 months. That's primarily been because energy prices rolled over, partially because of the Strategic Petroleum Reserve release, which ended up adding about 1 million barrels a day to supplies, and that had a big depressant on price. In addition to that, after the initial surge in natural gas pricing to feed natural gas, liquefied natural gas to Europe, after you had a Freeport explosion that shut down an LNG facility, and then you had a fairly warm winter here in the U.S. so far, and also in Europe, natural gas prices have also retraced dramatically and are down by 70% from their summer highs. So we've had a couple of big benefits in the energy sector to dampen inflation. Both of those are set to reverse, and with both of those probably being dramatically higher, both crude oil and natural gas being dramatically higher in 6 months, and then a year from now, that would be added inflationary pressure. But historically, the Fed funds rate has run over CPI, and so we're really not in a tight environment until that is taking place. So all this discussion of how tight the Fed should get is really just a lot of noise. And if people actually go back and look at the historical numbers, they'll see that the Fed is really not very tight right now, with a 4 3/4 federal funds rate heading toward 5.25. So a lot of panic, but the hope that the Fed would pause early, possibly reverse and start cutting, is clearly coming off the table. The other item that has been a little slower than the Fed promised, QT, that definitely allowed us to have a nice little rebound here the past 3 months in stocks. QT is definitely behind schedule. At the last Fed press conference, they did say that they are committed to QT and shrinking their balance sheet as per their schedule. So we'll see if they do a little makeup here over the next weeks and months. And if that's the case, that would add additional pressure to the stock market. Some of the studies coming out indicate that QT and QE in its reverse, as the market was rising, is actually more important to stock and bond prices than the level of the Fed funds rate. So we're about to find out if that analysis is actually true, as QT is set to shrink the federal balance sheet, and by implication should be a dampening effect on stock market prices and a negative impact on bond prices with higher rates in the future. So those are a couple of the items. We're also, witnessing this debt ceiling fight that we seem to have every few years. The debt ceiling fight is good theater, but the real problem is the deficit, running at around $1.1 to $1.3 trillion per year. The federal deficit is basically adding to our debt loads. Our debt loads have passed $32 trillion for the federal government. That doesn't count Medicare and Social Security, which are also 30 to $40 billion unfunded liabilities. So we basically have a situation where the federal government has outspent its capabilities, and that is inflationary. Really the only thing they can be doing at this point in time to fund these deficits is issue more debt, and the more debt that goes into the system, there's got to be people to buy it, and the buyer has been the Federal Reserve and foreigners, but at some point the foreigners are going to start to back off, and you've already seen a little bit of that with China here. Russia definitely had an issue with the way their dollar reserves were treated. And so the world is starting to back off a little bit on holding dollars, and that's going to be make it more and more difficult to finance the ever-increasing debt load at reasonable interest rates. So this will be an additional pressure on interest rates until, in our opinion, the Fed does reverse. At some point, the deficit and issuance of government debt is going to be such a problem that the Fed is going to be the buyer of last resort and basically going to have to come in and monetize these deficits and debts. This is going to be very inflationary when it does happen. I still think we're months, if maybe not a year away from that actually occurring. But at some point I would expect a reversal, and it's going to be key to be able to change your portfolio pretty dramatically when that reversal occurs. So this is my thoughts. This is how I manage my own portfolio. Right now I have more cash than normal, and I do think that we are probably going to have a very weak period in the stock market over the next few months. I do think interest rates are going to head back up as inflation starts to come back in, as energy prices reverse. So be cautious. Please remember to take a look at buildingbenjamins.com. where you can see our full disclaimer where we explain this is not investment advice, only what I'm doing with my personal portfolio. And you can also sign up for email and text alerts so you can get this information on a more timely basis. Hope you find this helpful, and have a great day. Thank you.